Hi, folks. We are going to get started. My name is Sharon Heaton, and I'm here with my very good friend, Alex Mears. Alex and I have done a presentation several times called VETS ETA, Entrepreneurship Through Acquisition. There were some challenges with VETS ETA because of the 51% ownership rule, and government contracting is not necessarily the best way of getting into entrepreneurship through acquisition. So we've changed the presentation, and this is really going to be about growth through acquisition, really focusing on kind of the GovCon market. Alex, would you like to introduce yourself?
Sure. Thanks, Sharon. So my name is Alex Mears. I'm a co-founder and managing partner of the Brydon Group, which is a committed capital private equity fund. We back 5 to 7 CEOs per year, a third of whom are veterans, to go acquire small businesses. And then we provide basically the private equity support throughout the whole life cycle of that. My background, kind of 20 years, more traditional large cap private equity, with one hiatus. I made the unusual decision after a few years at Blackstone to actually not go to business school and go back and join the military. So I was an intel officer with the SEALs. So I spent time in Iraq, Afghanistan, and Indonesia. Before my wife, who described it as like the greatest bait and switch ever, she thought she was marrying a stable Wall Street guy. And then I spent 5.5 years abroad. So came back and now I've been in private equity since then. So very passionate about this topic. We've both personally and through Brydon backed over 20 veterans doing acquisitions, either through entrepreneurship through acquisition or to enable them to grow their businesses.
So there was a little bit of conversation about this at the last panel where we said buying a company is not easy. It's expensive, it's time consuming, there's risks involved, et cetera. On the other hand, organic growth is not easy. It's much more time consuming. You're not borrowing money, so the risk might be a little bit lower, but you are going to take longer to get there, and you might not make it, as opposed to buying something that has already accomplished those goals. So we're going to be focusing on the growth through acquisition. And one of the things that the slides doesn't talk about, but Alex, I'd like you and I to talk a little bit about it. How do you get the money to do these kinds of deals? I mean, it's very nice to understand the process and all the rest, but I don't know that there's a lot of people sitting around with $10 or $20 million in their pocket that they can just simply write a check and buy a company. So how do you get that kind of capital? I think they gave me I have the power.
The power? All right.
I have the power. Okay, why would you buy versus build? Organic growth, that's basically building it. It is, we have a company, we want to grow. That's what Erica and Dawn were talking about at the last panel. There are reasons that you would buy to bypass barriers to entry. You might want to get into, let's say, the intelligence community. It's very hard to break into the intelligence community, but buying a company that's already there, you've kind of built that barrier. Earnings diversification. You are incredibly narrow, either in an agency or on a specific contract. You want to diversify a little bit. Strategic positioning, both Erica and Dawn talked about the importance of having a strategic plan and where they wanted to go. It could be for shareholder buyout. We did one deal where there was 7 owners of the company. We live in a capitalist society, but these folks actually were kind of a little bit more socialist of, hey, you're my friends, I'm going to give you 17% of my company. And they found out that having 7 owners was almost impossible to manage. So shareholder buyouts. Let's go into it in greater detail. Alex, do you have any comments about any of these?
Yeah, I mean, I think, before we jump into some of the specifics on this too, I mean, one of the things that we always try to emphasize is that, M&A or mergers and acquisitions or acquiring a business to tack on. I mean, it's like a core part of kind of the private equity value creation playbook that you see, but it is not only for private equity. And hopefully that's one thing you can take away is that I think what we see is often people are kind of a little bit worried about M&A or afraid, hey, I wasn't an investment banker, I don't know what's going on. But hopefully, through the presentation and some of the examples, I mean, we've seen it over and over again. It can be an incredibly effective and, in my opinion, like less risky way in a lot of cases to diversify the business, grow the business, develop past performance. And so there is some technical knowledge you need, but luckily there's a whole universe of advisors, including people sitting up on the podium who advise around this. There are, third-party diligence providers, et cetera, who support. So hopefully one of the takeaways is that this is not not only is this not impossible for many small business owners, but it's actually a very, very viable and in many cases de-risked way of growing your business and actually making your business safer.
Absolutely. So why would you buy a company? Expanding capabilities, greater access to clients. Again, I've mentioned the intelligence community. I have one client right now who is fairly large size, but all of their work is in DOE, Department of Energy. And they're very interested in doing work outside of DOE. So they're looking at companies that actually don't have profit margins quite as good as they do because they want to be in DOD or Army Corps or whatever it might be. So expanding access. Shift to full and open. Gosh, that's an incredibly important one. We haven't talked a lot during this conference about the designation world, with SDVOSB, women owned, et cetera, versus the full and open. One of the things that we're seeing more of are companies that are basically going to be sizing out of their designation code, doing an acquisition, because it's a heck of a lot better to size out big than to size out by $1 million. Because then you have some economies of scale, you've got some benefits that you might not otherwise have. So we're seeing more as companies are getting larger and those NICS codes have not been raising as much as we would like to see them, seeing people do mergers in that. Improving past performance, getting past performance from other sides, and to attract teaming partners. So there's a lot of reasons why you might want to do an acquisition as opposed to building it internally. Let's talk about the phases of buying a business. Now, as you look at this, we have just a 3-part process. I've seen everything from 30 parts to 7 parts to 12 parts. So it's not like it's magic, but we just kind of put it in easy terms. The first is preparation. And Alex, I'd like you to talk about that. If you're advising people who are interested in buying a company, what kind of preparation do they need to do before they actually say, let's go start looking at companies?
Yeah, absolutely. I mean, the first thing is just know yourself, right? So what we always recommend is really deeply understand what is your strategy? What do you want the business to become? What are their core customers that you want to go pursue? Are there core capabilities that you don't have that you want to build out? And knowing that first is by far the most important thing, because there is a universe of businesses you can go acquire. What the most important thing, and when M&A doesn't go well, it's typically because we bought it because it was for sale. That is not a good answer. Right? Know what you want and what your business needs, or would fit well with your business first. So we always recommend, like, whether that's the industry focus, geography, like literally come up with a prioritized list of what you're looking for in a target, in a potential acquisition target. The next piece that we always say is know where are you today, right? I mean, if you have $1 million, $2 million of cash flow, you're looking of EBITDA or profit, and you're looking to go acquire something of similar size, all of a sudden there are lenders, banks that will lend to help finance some of that acquisition. There are actually equity sources of equity financing too that we can talk about at some point. But just knowing where you are, size-wise, financial capacity-wise, often will go a long way in terms of determining, there are many different routes you can go down on the financing thing. But again, you have to know yourself and where you stand before you answer that. And then the last one is just understanding kind of like, what are you good at in your company? What is it good at its core? And use that as a basis for, oftentimes, I'm sure you see the same thing. We often recommend, sometimes it's better to get the company's house in order a little bit better, for example, financially. Like put stronger financial controls in place first, and then go look to do the acquisition if the company's in that place. Because it's obviously, once you buy another company, you're dealing with an integration, post-merger things. Always better to do that work kind of on the front end before you even get into a process. And again, a lot of it's not hard. It's just a question of prioritization and understanding where you are and your company's capabilities.
It's very interesting. We were talking to a company that wanted to go out and buy, and we went through this kind of first thing preparation. And I hadn't thought of it that way, but it's to thine own self be true. Understand who you are and what you're good at. We looked at their financials because we were looking to determine how much money could they borrow, and did this make sense? And their financials made no sense whatsoever. And so we turned to the owner of the company and we said, what's your plan here? I mean, a bank's going to look at this. So they said, oh, yeah, but we're going to have to do post-merger integration. Once we acquire this other company, we'll fix ourselves at the same time we're fixing them. To which I said, I laughed. First of all, nobody's going to give you money. You're not going to be able to get the capital in order to do that transaction. And second is, post-merger integration is hard. It is hard to do when you're taking in one company. If you're trying to fix your company at the same time, not a great place to be. So you really want to have your own house in order. The other thing I wanted to add on the preparation side is the one thing that you shouldn't do is buy a company just for revenue. If when people turn to me and say, yeah, I want to buy a company, I'm 15 million, I want to be 30 million, so I'm going to buy a company. It's like, bad reason, bad reason. Buy because they have a capacity, they have a agency relationship, they have CPARs, they've got whatever it might be, but revenue alone is not enough. So having this phase one is really looking at yourself and being honest about your strengths and challenges, because you are going to be selling yourself to the seller in the same way that the seller is trying to sell themselves to you. Those sellers have a lot of options at this point. There are a lot of buyers out there. You want to be on the list of a preferred buyer by kind of knowing what you are and what your strengths and challenges are. Mm-hmm. Let's talk about identifying targets. At Brydon Group, you guys are very involved in trying to identify targets. How do you go about doing it?
Yeah, I mean, there are a few things, and I always say, like, when you go out to start identifying targets, one of the most important things is there is a whole universe of advisors in and around in an ecosystem around M&A, around doing acquisitions. Do that now, not post. Like, don't generally do that right now before you go and start those conversations with owners, because ultimately, once that process starts, you'll want a legal team in place, an accounting team in place, potentially. And when I say team, I mean, they're outsourced providers who are actually relatively inexpensive. This is not like you're going and hiring a giant New York law firm. And then also talking to M&A advisors. I mean, I think that's incredibly important to get a sense for kind of, hey, this is who we are. This is what we're looking for. What are you seeing? What do you think might be a potentially good fit? I recommend all that before you even go and talk to the first potential target, just because getting your ducks in a row before that process starts is incredibly valuable. So once that portion is done, yeah, I mean, then the next thing is use your network to try to start finding opportunities. I mean, the great thing is if you already have an established business, you'll often know of competitors who might be potentially interesting. Events like this, I mean, there's a whole universe, conferences, M&A advisors, even, I mean, in GovCon specifically, there are accountants who everyone uses as outsourced accounting. Go talk to them. They often know targets. So that to me is the next phase. Is once you understand what you're looking for, go and communicate with your network about what are the features, right? And be very transparent, right? If you can't afford more than 15 million of revenue, don't tell people you're looking for a $50 million acquisition or a $60 million acquisition. That's not in your interest nor in anyone else's. And so really kind of narrowing down those parameters for what you're looking for and then communicating that appropriately to the various kind of stakeholders in the ecosystem is incredibly valuable.
Let me emphasize that point for a moment. sbLiftOff is an M&A advisor. We work on both the sell side and the buy side, mostly on the sell side. When we're getting ready to sell a company, we put together a list of potential buyers for that company. But one of the first things that we do is we take a teaser, blind to who the company is, and we send it to lawyers and accountants and commercial bankers and anybody else who's kind of sophisticated in the market, because there may be companies that are not yet telling people that they want to buy, but they've told their lawyer or their accountant. And we've been very successful at finding buyers in that way. So I really want to emphasize Alex's point that talk to your lawyer, talk to your accountant, because they will hear of more opportunities than you will alone. Mm-hmm. So that's a very important element of reaching out. In addition, you're going to need to be able to do things like due diligence, the financial analysis, identifying debt sources, and legal and tax support. M&A is a team sport. It is not, I'm going to go out and do this, and I built my company so far by myself, and I don't need any. M&A is a team sport. Make sure that you're comfortable with the folks around you, and they should not be yes people. They should be people who can stand up to you and say, "You're wrong. You're making a mistake in how you're thinking about this." You don't have to take that advice, but you should listen to it and decide whether or not you're going to go off on your own. Yeah. That identifying targets phase is what I refer to as the dating stage. Because, hey, listen, you might find the perfect company for you to acquire on your first teaser and confidential information memorandum, but chances are you're going to have to kiss a bunch of frogs first. And you might decide that this is a great company, but I'm too early. I don't quite know what I'm doing. I want to keep on going. That makes sense. So it's hard to know exactly how long that phase is going to take. A lot of it goes by how prepared are you? What did you do in phase one? We have a client at this point on the buy side, and it's one of the reasons why it's less fun to work on the buy side, because they change their mind all the time as to what they want. Well, I'd like it if it were a little taller. Or, no, that's a little bit too wide. Or it's red, but I want it pink or rose. You know, the more you have an idea of what it is you're looking for, the greater the likelihood of A, you finding it, and B, finding it in a relatively shorter time period.
Mm-hmm. Yeah, I mean, the other thing I would add to that is don't forget, even though you are technically, quote, the buyer, you have a value proposition that you need to convey to sellers, right? It's often not, especially at this end of the market, it's often not just, hey, I've got a pool, a bags full of money I'm going to give you at the end of the day. Certainly valuation matters, but a lot of it is like, why should a seller, why should a sell-side M&A advisor talk to you, right? And that's not a negative thing. It's just like, make sure you have a clear value proposition. Hey, this is who we are. This is why we're a great potential acquirer. We've not done any acquisitions to date, but we have all of our ducks in a row. This is the size of the business. When an M&A advisor, a sell-side M&A advisor hears that there's a lot more credibility than like, I don't know, we want to go buy 20 million of revenue. I mean, I won't speak for Sharon. If I heard that, I'd be like, okay, not the right, put that in the reject pile.
I find that very often on the sell side, sellers don't pick the highest purchase price. They will pick the company that they feel is going to be most capable of running their company, giving them a fair price. I'm not saying that price is unimportant. It's very important. But very often these things come in within a relatively small price variation. But who will treat my employees well? Who will ensure the quality of work that's being done for clients? Sellers decide on a lot of factors, and one of them is, do they like the buyer? So I've seen buyers walk into a room and kind of sit down at a chair, stick their feet up on the table. Swear to God, this happened. A buyer walked in and said, let me tell you what you're doing wrong with your company. And I looked at that and I said, we could end this meeting now. There was no respect from that buyer to that seller. And it was like, you could put the best offer on the table, but this is not going to go anywhere. So particularly if you're dealing from the buy side and you're trying to buy from a company that is owned by the founder owner, the founder owner is a special kind of creature in the world. And it's important that you understand that they think of that company very much the way they do a child. And they are emotionally committed to it. They're financially tied to it. They've been working on it for a long time. You as the buyer need to show respect for what that seller has accomplished so far and basically sell it in terms of, I really appreciate the platform that you've built. I think I can take that platform and bring it to the next level. That's a compelling story, not I can do this better than you.
Yeah, I mean, the last thing I would add, and this is, I think, where phase two really ties into phase one, is it is totally fine to not know what you're doing. This is presumably the first acquisition you will have ever done. The key is to acknowledge that and then go find a great advisor who can help you, right? I mean, I've been doing nothing for 20 years but transactions, with a hiatus to hunt terrorists for a few years. But basically all I do is transactions, and every single one of our deals, we hire accountants, we hire a lawyer, we hire, like, we are using third-party advisors to help support our transaction, because transactions are hard. It's fine to acknowledge that, hey, I don't know. And where I've seen people run into a lot of trouble is like, oh, I got this, I can do it myself. Deep down, they know that they don't, I mean, they've never done a transaction before, they don't know, and again, that's totally fine to not know. It's just that, just know that and go find advisors, because this is where that starts to come through very quickly when you're in discussions with sellers or with sellers M&A advisors. Like, it will become very clear, if you have the right people around the table. I love it. M&A is a team sport, no matter what. M&A is a team sport. If you take nothing away, even if you have the best in-house CFO, finance person, best in-house legal, I'd still recommend, like, there are people who do nothing but advise on transactions. Work with those people.
That's a very important point, the team sport element of it. But it's very interesting. Most of us have either bought or sold a house at some point. About 92% of people who are trying to sell a house use a real estate agent. Now, we know how to sell a house, but 92% of people do. On people who are selling their company, the percentage of people who use an M&A advisor, much smaller. I've seen people try and negotiate a deal by themselves, buyers and sellers, no advisors trying to negotiate a deal, signing an LOI, and then bringing in advisors. And very often, those things blow up. In GovCon particularly, upon the signing of an LOI, if it's done badly, you can have an affiliation between those two companies. That can be disastrous because maybe that deal's not going to go through. Maybe you're putting some proposals in and you're going to blow because of that affiliation rule. So that's pretty darn important. One of the things that I think is very important, and we'll talk about a little bit more, is due diligence. We work, as I said, primarily on the sell side, but we work on the buy side as well. We will not allow parties to sign a letter of intent unless a fair amount of due diligence has been done prior to that letter of intent. Every company has strengths, every company has weaknesses. It's really important for you as the buyer not to focus solely on, I'm going to find the perfect company, because the perfect company, A, doesn't exist, and if it did, it would be very, very expensive. But to recognize what are the risks you're willing to take and what are the things that are just kind of off the table for you. So the only way to do that is to do due diligence. Buyers who say, I will sign a letter of intent and then do the due diligence afterwards, we won't let our sellers actually go forward with those. And that's not what you as a buyer should be doing. You should be being pretty cautious because if you get a reputation of signing LOIs and walking away from them, that's going to be something that will go on in the market, and that's not going to make it easier for you going forward. So that phase two is kind of the dating. It ends with the signing of a letter of intent. And the letter of intent is really important for two reasons. First is, while it's non-binding, the part in it that is binding is that the seller is giving exclusivity, which means that the seller can't talk to other potential buyers for 90 days, 120 days, whatever the provision calls for. So the seller actually is doing something significant, so they feel very strongly about, do I have the right buyer? The second element is there's a little bit of a shifting of the power dynamic. I find that in phase two, the buyer's pursuing the seller, and there's, as I said, a bit of a dating element. In phase three, once that LOI is signed, it's really all about the buyer. Is that?
Yep. The LOI is like the engagement ring. It's kind of how I would characterize it, right? You're not married yet, but there is clearly strong interest, and we recommend that both parties know who they're getting engaged to, right? Very well before that happens. So absolutely.
We talk dating, ending in the engagement ring, and the marriage is really the beginning of the relationship. That's kind of the closing. Yes, now you're married, but there is no such thing as happily ever after. Once you get married, you still have to have a lot of things that are going on. Let's talk about that phase three, the LOI to closing. You've gone through God knows how many transactions. Yep. From the LOI to closing, what happens there?
Yeah, so once the business is under LOI, and I'll speak from a buyer perspective and then the seller perspective. So the buyer generally is doing a lot of what we call like the commercial diligence upfront pre-LOI to really understand, like, if it's GovCon, like what are the contracts the business currently has, like look at the contract waterfall, arriving at evaluation, all that. Usually post LOI is where buyers really start spending money. So this is where you're actually going to start running up the bill with your accountants and your lawyers. And the reason that buyers wait for post LOI is like they want to know that, hey, we have a handshake in the form of an LOI on high level valuation terms, right? There's still a lot that needs to be negotiated, finalized, et cetera. But at least we have kind of a meeting of the minds that, hey, we're in exclusivity. We have at least a high-level agreement on valuation and deal structure. And so now as a buyer, we're going to start spending money. The seller at the same time is now basically responding to all the buyer's requests. And this is one thing that I think is important to remember, and it's notified, it's up here. unless the buyer has literally all the cash on its own balance sheet when it's doing the acquisition, which is exceedingly rare in any M&A, especially in small business land. Really, there are kind of almost two transactions that the buyer is doing at the same time. One is the obvious one, right? One is the buyer-seller transaction, like literally buying the business or the assets that the acquirer is acquiring. The other one is they will need to raise financing for that. And that can be in the form of debt, whether that's a bank or an SBIC fund or mezzanine lenders, or equity, right? Whether they can go out to, again, there are some lender or there's some third-party equity providers, or just going out to a whole range of equity providers. Those are two kind of like very distinct work streams. And so one of the things that we see is sometimes sellers can get a little frustrated because they're like, oh, we thought we answered that question in the first place. Oftentimes what that is a lender, for example, who is going to be lending the buyer some of the money to do the acquisition, has specific requirements that they have to meet, and certain diligence items that they need to be addressed. So during that phase, this is where commercial diligence is being kind of finalized. This is where accounting diligence oftentimes is done, where if you ever hear of a quality of earnings or a Q of E, that's just saying, hey, the seller said their business had $5 million of revenue and $1 million of profits last year. Like, what was it? Like, we'll go hire accountants, and they'll go and dig in and look in the QuickBooks and look at the bank reconciliations, et cetera, to prove that out. There's legal diligence, right? Understanding, hey, was the business properly formed? Are there outstanding lawsuits? All that stuff. And the other piece of legal is obviously the creation of all the legal documentation around the actual acquisition. So sale and purchase agreement, unit purchase agreement, oftentimes there are lease agreements. Those are all being created oftentimes first by the buy side lawyer, and then those go back and forth to the sell side during that negotiation.
I changed the slide because this is very much what Alex was just talking about. Mm-hmm. From a seller's point of view, you have two jobs. Your job, first and foremost, is continue to run your company well. The saddest thing I see is when a seller goes to market and they take their eye off their company because they're so focused on the M&A that the company begins to drift and profits go down. And you may have a deal, but it will fall apart because the company is not what it initially was. So the first responsibility of a seller is to run your company well. The second responsibility is to deal with the transaction that's pending. That's a lot to juggle. The seller has to have some level of empathy for the buyer, because the buyer is probably doing three things. First, they've got to run their own company, assuming they have one. Two is they've got to negotiate the deal with the seller. And three is they've got to negotiate, as Alex said, an entirely different deal with the financing source. So they've got three different things going on. And we find that buyers who can think like sellers, sellers who can think like buyers, having some level of empathy for what's going on the other side creates a more stable transaction. Because it's not a, why are you asking me for the same information a second time? It's like, oh, the bank needs this, understood. One of the advantages of working with really good advisors is that if you answer the question once, when that same question gets asked a second time, we have the answer. But if you're running your company and you're trying to do this on your own, whether you're on the buy side or the sell side, it's challenging to always put your fingers on the right piece of paper at the right time. That shouldn't be what you're focusing on. Mm-hmm. So successful transactions really require an understanding from the others, from you, what's going on the other side.
Yeah. Yeah, and I would just add to that, and I mean, it's completely non-financial, and this is coming from the person who's worked 20 years in private equity. Like, integrity and trust is extraordinarily valuable. That is the only way deals get across the finish line, and it's on both sides, right? So for the sellers, for example, when we have a business for sale that we're looking at, when a seller comes out and is like, hey, these are the 5 great things, and these are the 2 risks, like, you should just be aware of it. We've been working on them, and then we get into diligence. There's just a level of trust that gets built up that way. The absolute worst thing for a buyer is that the seller tells you everything is perfect. Yep, all of our customers totally happy, all of our CPARs, darkest blue you've ever seen. And then you get into diligence, and it's quite the opposite, right? They've churned a bunch of customers. And that, like, when we see that, we just walk, right? Because guess what? If a seller's not going to tell you the truth, in that phase, like, there's usually other skeletons in that closet, right? They've generally not been entirely honest with their customers, their employees, et cetera. And the exact same thing goes for the buyers, right? And you do see this in the market. If a buyer says, hey, I'm going to pay you $10 million for your business, gets it under LOI, and immediately starts like chipping away at oh, well, we found this and we found this. So really it's 8 million. No, now it's 6 million. it just erodes trust, and that gets around very, very quickly in the market. Who are people who are dependable actors? And so I mean, we always say, like, when we are working with our CEOs, my first question, which is always a surprise to many of them, is like, not what is profitability, not what is revenue. It's like, what's your assessment of the seller's integrity, right? Because a business is nothing more than a culture that a human being has created, right, with other people, and inevitably that's absolutely critical on both sides. And the only way you're going to negotiations can get very, very difficult if there's an underlying level of trust and integrity, and a buyer is able to put themselves in the seller's shoes and vice versa. That's the only way deals get done. So just keep that in mind kind of throughout the process.
Alex just made an incredibly important point, which is sellers need to be honest about the strengths and challenges of their companies, because I've never yet seen a company that had no challenges. If you don't reveal those challenges prior to the LOI, 90% likelihood that the buyer is going to find it post LOI, and they're going to think one of two things. Either they knew about this and they didn't tell me, so I've got an integrity issue, or they didn't know about it, which means that they don't control their company, which means that this is too risky for me to go forward with. So thinking that you could just hide it and you get it through the end of the process, highly unlikely. Further, even if you were successful, a purchase agreement between the buyer and the seller is about 2/3 representations and warranties that the seller is making about their company. If you haven't disclosed those things, and it's not on their disclosure schedules, it's not in the reps and warranties, et cetera, you're probably going to be held liable for it afterwards. So it's a very short-term strategy and a losing strategy to try and hide those things. And that kind of goes to the slide that's here right now. People talk about due diligence all the time. What the heck is due diligence? Due diligence is research. It's understanding what's going on. And I think that due diligence is kind of a three-part process, which is first, know thyself. If you're the buyer, as we talked before, what can you afford? Why are you buying? What are you trying to achieve? How does this make sense? If you're the seller, then you should absolutely be thinking about, what is a third party going to see when they start looking at my financials, when they look at my contracts, they look at my HR, et cetera? Do due diligence on yourself. That's the first stage. The second stage is the due diligence that the buyer needs to do prior to signing that LOI. Incredibly important that they understand the commercial terms of that relationship. What does that company do? Why do they do it? What's the moat around that company that protects them from other competitors, if any? Really understanding what that company is and how it works. And then third is the clown car of due diligence that occurs after that LOI, when the wheels come off and you've got a zillion lawyers and advisors. But again, as Alex said, that's when the money really starts to get spent by the buyer. So they want to have exclusivity. That's why it's so important for sellers to be careful about who they go into a deal with, because they are handing over exclusivity, and the buyer needs that because they're going to open up their wallet.
Mm-hmm. Yeah, absolutely. And obviously, I mean, due diligence, like literally there are multi-year courses on like conducting due diligence. So this is obviously a summary of what it is. But
Very much a summary.
It's understanding, what does the business do? How do they do it? And what, as a buyer, how do you value the company, right? That's at its core. And obviously there's 100 different work streams, from customers, contracts, legal, HR benefits. I mean, everything in a business basically has to be sort of encapsulated in due diligence. And one of the other things to emphasize again is the seller is almost always going to know more about their business than the buyer. Like, that's just true. You can spend millions of dollars on the best advisors in the world, and the seller who's founded the business, been in the seat for 30 years, they're going to know the strength of the customer relationships better than you ever will outside in. And so it's just important for both sides to remember that kind of fundamental feature of an acquisition, right? The sellers have to be very sensitive to, like, look, the buyer's not just trying to poke and prod. Like, many times, I mean, there are probably not family
tire kickers.
Tire kickers. Well, and also descriptions of what due diligence is in various exams.
Exactly.
But the seller has to understand that the reason the buyer is doing that is because they're trying to do their best to understand really what makes the business tick. Like, what are the strengths? What are the weaknesses? It's great that the seller said something, but the buyer needs to validate that in the numbers or in third-party research and things like that. So that's really what due diligence is trying to get at. And the buyer has to understand that the seller's still trying to run their business, right? I mean, this is like, this is not the seller's only job to respond to like random data requests that the buyer's HR benefits advisor is asking for. And so kind of balancing all that, what does the buyer need to know with the kind of capabilities and even oftentimes the information that the seller may have. Like many times sellers just come back to us and they're like, I just don't have that information, right? Like it's not something we track or whatever. So understanding that balance is kind of critical to the due diligence process.
In this area, particularly for smaller companies, one of the areas that we always have buyers ask for, and about 50% of our clients can answer, is what are your profit margins by contract? Sometimes they basically are doing all their revenue, all their expenses, they come to a bottom line margin. But if we say this contract represents 30% of your income, what is the profit margin on that contract? We find a huge number of sellers cannot answer that question. So that becomes an issue for a buyer to say, is that a risk I'm willing to take? And to look into a little bit more to see what's the gross margin. You can almost always tell the gross margin, but you may not be able to tell the net margin. So these are the kinds of things that buyers need to be dealing with. I also want to emphasize what Alex said, which is on the day of closing, the seller will always know more than the buyer does. And the buyer is going to be nervous because they are willing to buy a company, take a risk on that, but they don't want to step into the problems of the seller, particularly if they don't know what those problems are. So that's, again, where that empathy comes in. Sellers need to understand that buyers are asking these questions, not just to be a pain in the butt, but because they really need to know. And very often, the questions become more detailed once the bank gets further into it, that there's a certain level of questions that the buyer's been asking, but then there's a much deeper dive when the bank is doing their underwriting for the transaction. Okay, this one we talked about. Now, this goes again to the sharing between the buyer and the seller. Assuming that you're not sitting here with $20 million in your pocket to do an acquisition, how do you as a buyer buy a company? There are 4 ways that sellers get paid. The first is cash at close. Every seller wants more cash at close. Every buyer wants to provide less cash at close. So that's a negotiated level. Usually it's somewhere between 50 to 80% cash at close. For that cash at close, the buyer is generally taking some money out of their pocket. I think the days of buyers being able to buy a company with no money down are a little bit past right now. But it's largely going to be financing. Sometimes they might have an equity component, they might have debt, but that's where that cash at close is coming from. The second is seller financing. And particularly in deals that are less than $50 million, seller financing is playing an increasingly important role, in part because banks have pulled back a little bit in the last year or two. It used to be that you could pretty much count on a bank providing funding equal to 3.5 times the joint EBITDA of the buyer and the seller. So let's say each party has $2 million of EBITDA, so now it's $4 million of EBITDA. The bank would lend 3 times that and say, okay, you can do a $12 million acquisition just on the debt financing. They've been pulling back. I'm seeing more like 2.5. You can push it to 3, but some are even saying, no, I'm not going to go above 2. So finding the right lenders who will do M&A financing, and not all banks will. M&A financing is a very unique thing. As a result, seller note financing is becoming an increasingly important element of it. And one of the important things about seller note financing is that the buyer wants to see, does the seller believe in this company? Are they trying to drop their keys off on the table and walk out the door and say, it's your problem now? Or do they believe in their company enough to say, yes, I'm willing to carry some level of debt. This debt is definitely subordinated to the bank debt. It's absolutely subordinated to it. But there are some positive elements to it. Do you want to talk about rollover equity? Do your deals ever do rollover equity?
Yeah, I mean, so we do consider rollover equity. So I think out of 8 deals this last year we did, 1 of them had rollover equity. Everyone has a different philosophy on it. We generally look at it as if the seller is going to continue playing a critical role on a go-forward basis, kind of post-close, it's great to have rollover equity. And when we say rollover equity, literally what that means is if you're paying $10 million for the business, if 9 of that is cash, 1 of it is literally just in equity that the seller then retains in the new combined entity. So it can be a great way to kind of keep seller skin in the game if that's very important. It also is often a great way for sellers to show confidence. Again, back to that inevitable like asymmetry of information that the seller is always going to know more about than the buyer about their business. It can be a great vote of confidence as a buyer when a seller's like, hey, I want to roll as much as possible, right? So yeah, it's something that we certainly use. It also can obviously help bridge financing gaps, right? If a buyer can't raise additional equity capital or additional debt capital, it can still be a form of consideration and additional value. I mean, I don't know if you've heard like the proverbial second bite at the apple, which actually can be very effective oftentimes, right? Especially if it's a bigger business buying a smaller business, many times it can actually be a really nice way. And I've seen many times where literally the value of a relatively small portion of the equity that got rolled was actually worth much more ultimately than the upfront consideration that the seller achieved. So absolutely something that is, we consider on all of our deals. Earnouts are another way. I mean, earnouts can get a bad name, especially poorly designed earnouts. But an earnout, think of it as basically it's a form of variable consideration that a buyer will pay a seller if certain things happen, right? So for example, let's say a seller has one contract, it's 30% of revenue, and it's up for recompete in a year. Well, I mean, one, you probably shouldn't buy that as a buyer, but if you do, one of the ways to bridge the value gap there, right? Again, think about it from the buyer's perspective. They have no idea if that contract's going to be renewed or not, or if they think it is, surely the seller knows more, right? And why is the seller selling right now, a year before that contract comes up? So one way you can deal with that is through an earnout, right? You basically say, hey, we'll pay you $5 million today, and we'll pay you another $3 million if that contract does get renewed on substantially the same commercial terms. So again, earnouts, they can be designed very poorly, and that's just a recipe for disaster. Don't design bad earnouts because you just like inevitably turns into a fight between buyers and sellers. But we've used them very effectively as a bridge in value. So that contract example, we see it the other way, where a seller's like, hey, we've been growing 10% a year. We think we're going to go 30% next year because this one, new customer who's in the pipeline. And we'll say, that's great. Yeah, we talked to the customer or the prospective, they're very enthusiastic, but like, we're not going to pay you for that prospective growth on a go-forward basis. So let's structure an earnout. Hey, if we win that contract, if we win that customer, it represents 20% growth. We'll pay you half that, basically. We're half the additional value. So it can be a very effective tool to kind of bridge valuation and risk between a buyer and a seller. But please think about all the secondary and tertiary ramifications of how it's structured, because I've also seen many that are designed very poorly. And if you have a poorly designed earnout, you will have an unhappy buyer and an unhappy seller in a year, I promise you.
Earnouts historically have been based upon the ongoing profitability of the company. Well, profitability is basically revenue minus expenses. You sell the company, the buyer is now solely in charge of what those expenses are going to be. All they need to do is hire a whole bunch of back office people or give people raises, and they've just blown that seller's earnout. And that's when you get a litigation magnet. That's when everybody starts getting angry at each other and litigation. It's a terrible idea. It needs to be done on things that are binary. The example that Alex gave, we often hear our sellers say, we are 100% certain that we're going to win this recompete. It's like, great. Don't you then need to take the risk on that? That's not a buyer risk that they should be taking. On the example that Alex gave, with 30% of the revenue coming up, we would probably, from a seller's point of view, as well as a buyer's, try and advise the parties, value the company without that 30% of revenue, and then do an earnout if that contract is won. And we'll do earnouts based upon a revenue share, because revenue is pretty objective. You either got the revenue, you didn't get the revenue. So if there's a 10% margin on the work and the seller is going to get, let's say, 3% of the revenue, that means that there's a little bit of sharing. And if it happens, both the buyer and the seller should be very happy. But if it doesn't happen, the buyer hasn't paid for something that didn't have value. So we think that earnouts are extremely important, in part because entrepreneurs are very optimistic people for the most part. They are convinced, I have this proposal, I have this, recompete, I know I'm going to win this. And you need to have that kind of confidence to give up a job and have a company and all the rest of that. In contrast, buyers are nervous. So buyers will pay for what is at the table right now. They buy for the future, but they pay based upon what the company is today. The way in which sellers can get to share in that value is through an earnout. So it's unfortunate that earnouts have such a negative reputation because they've been done so badly for so many decades. But people are wising up as to how to do it smart in a way that's good for both the buyer and the seller.
Yeah, and one of the unique things, if you look at numbers 2, 3, and 4, all three of those are basically just additional ways a buyer can give more money to a seller while keeping seller skin in the game, right? And keeping those incentives aligned. So again, on all 8 of our deals, we had at least 1, if not 2, and one of them we had all 3 of those kind of tools to use. Just obviously it's very business and situational dependent. But at the same time, like these are great tools to, if done right, to help keep seller skin in the game and potentially get the seller additional consideration than they would have if they were just demanding, hey, pay me all the cash at close.
When you use items 2, 3, or 4, it's called a structured transaction. So if somebody says, I want an all-cash deal, I don't want any structuring, that's what they mean. But they very rarely actually know what they're talking about. The structuring is actually how you can get greater value. If you buy something or if you're selling something and somebody says, I'll give you all cash for it, you generally give them a little bit of a discount. If in fact you're willing to take some structuring, the likelihood is that your multiple is going to go up. You might have a company that arbitrarily is a 5 times EBITDA multiple company, and maybe it's only 4.5 if it's all cash, but it could be 6 if you're willing to do some structuring and share in some of that risk. So there is a upside to the seller, but they are making a continuing investment. And I find sellers get really nervous about that because they've controlled the company for a lot of years. Now they're giving somebody else the company, but they still have some economics riding on it. So you need to make sure that the amount of cash at close that you're getting is satisfactory to you, but recognize that there's continuing upside in that process. Okay, people forget about transaction costs. These deals are not necessarily cheap to do. So we put down here very rough numbers, and they vary depending upon the size of the deal. So this is for deals that would be, let's say, $20 million, give or take. Legal fees. Lawyers are expensive. I say that as a recovering attorney. And there's lots of different law firms out there. Many of them are absolutely wonderful. But sometimes a small firm could be less expensive and can do the same work. What we think about law firms is, please go to a law firm that does M&A and does it in the sector in which you're going to be buying your company. If you've got a son that just graduated from law school or your brother-in-law who did your trust and estate, have dinner with them, but don't have them do this transaction. This is a complicated process. You want to have really experienced people. You're having your hip replaced. You wouldn't want somebody who's doing their 3rd hip replacement. You don't want somebody doing their 3rd M&A on your dime. Do you want to talk about accounting firms?
Yeah, and just to reiterate, I mean, we literally did a deal this year, and apologies to any divorce attorneys in the audience, literally where the seller used their divorce attorney, and it's just a nightmare. It is no one wins, right? Like they had never done M&A. It was like we spent half our time just explaining like the basic terms of a purchase agreement. So find someone. You can get at every level, right? So it's not even a cost thing. Like in fact, the divorce attorney ended up costing vastly more than if he had just hired a normal, M&A advisory.
Incompetence is very expensive.
It is very, especially when charged by the hour. So just to reiterate that, accounting, yeah, and again, this is even if you have a strong accounting function in your business, a great CFO, a great controller, we always use third-party accountants who do nothing but these outside-in due diligences, and generally the output of that, as we mentioned, is kind of a quality of earnings and some other financial analysis. But yeah, I mean that's pretty typical, the $30,000 to $50,000. I mean it's not cheap, but do not buy a business unless you've done this, because they're really there to help validate that the numbers are what the seller is representing. We find that the accountants come in 2 ways. The first is, of course, the quality of earnings, which is generally paid for by the buyer. It's a buyer report. There's an increasing emphasis on, particularly from the accounting firms, saying that sellers should do quality of earnings before they go to market. And probably that's a very good practice. I've just not seen a seller willing to do it yet, saying if the buyer is going to do it, let it be their expense, not mine. The second thing that really the accounting firms become very important in, 2 others. One is setting what's called the net working capital target.
And net working capital target is a seminar in and of itself, so we're not going to go too far into it. But we find that we spend as much time negotiating net working capital targets as we do purchase prices. So net working capital is pretty important. Your accountant's likely to be involved in that. And then the last, particularly in the GovCon sector, most of these deals are done as stock transactions. And you do them as stock transactions because the buyer gets to have all the contracts of the seller without going through the brain damage of novation. Novation is when the government has to expressly approve a contract moving from one company to another, and it can take a long time depending upon what's going on. If, however, there's a stock deal, then those contracts go over automatically. Having said that, asset deals, not stock deals, are better for the buyer. So what often happens in these deals is something called a tax election, because in the United States, we have to make our tax code even more complicated. So where there is a provision, many provisions actually, that say, we know you did this as a stock deal, but we're going to let you treat it like it's an asset deal. The significance of that is that the buyer's taxes will often go down precipitously. They will get a goodwill adjustment for up to 15 years. It can often be worth millions of dollars to them. So from the buyer's perspective, they really want this. The other side, however, is that it does raise the seller's taxes. The seller does better under a stock deal than under an asset deal. So how this generally works is that if in fact the benefit to the buyer is so significant, then the buyer will basically true up the seller, and they'll do something called a gross up. What would the taxes be to the seller if it was done as a stock deal? What are the taxes now because it's an asset deal? The buyer will pay that difference grossed up for taxes. You definitely will need the accounting people for that. It's a complicated analysis, and it's not insignificant money depending upon the deal. But it's very common in the GovCon world, particularly, for these to be done as stock deals that then for tax purposes get treated as asset deals.
Yeah, another reason to actually use advisors who are expert in this. I mean, I would say probably on a third of the deals we did last year, the average value of the tax benefits generated by the transaction were a few $1 million, right? I mean, it's real money, and doing it right can be extraordinarily valuable for the buyer, and doing it in a fair way I mean, it all has to be mutual, right? So absolutely bring in advisors. Kind of don't try to DIY this.
Next one is M&A advisory. We think that that's incredibly important. Big surprise there. We think that, and we've actually done some studies recently, we are bringing more value to the deals that we work in than we're actually charging. Whether it's a better negotiated purchase price or the amount of interest on seller financing or tax true-ups or whatever it might be, you should be having an M&A advisor that brings value to you. They're going to cost you something. However, they primarily get paid upon the closing of the transaction. So they're in it with you. There's usually some fees that are non-contingent, but the vast predominance are contingent. So you want to have somebody who's really in that with you as the seller. There are some deals where there's an M&A advisor on both sides. In the under $40 million market, it tends to be on one side, not the other. If you're working with a PE firm or sponsors that are backing people, they're sophisticated in and of themselves. They may not need an M&A advisor, but the seller almost always will.
I would just add, I mean, as a buyer, we actually preferred when a seller has an M&A advisor. And the reason is just that. I mean, one, it shows a certain seriousness on the seller's part to actually sell the business, right, to transact. But two, inevitably, there are things where if someone's not done a transaction before, it looks insane, right? When all of a sudden you're doing like the working capital negotiation and then the reps and warranties, and it's like, there's a list of 1,000 things. And you're like, well, I did that. I didn't do that. Having someone who's an intermediary to help kind of translate between the buyer and the seller can be extraordinarily valuable to getting a deal done for both sides.
In the idea of translating, you may have seen that there is a book up front called LiftOff, 12 Things to Know Before You Sell Your Company. And it's really designed to walk through these slides in a much greater detail. And it's written for business owners. It's not written for advisors. So in a very non-jargony way, trying to explain what's going on here. Do you want to talk about quality of earnings?
Sure. So this, as we mentioned, this is where the accountants are going to be usually for the buy side, for the buyer, are evaluating, are the seller's numbers real, right? In very, very simplistic terms. Do they tie out? And the reason why, so you'll hear this all the time, like last 12 months adjusted EBITDA or trailing 12 months adjusted EBITDA, LTM EBITDA, TTM EBITDA. Deal people just like vomit this stuff. It's extraordinarily important because it's basically what is the company's last year cash flow. All of the lenders, all the banks are hyper focused. Basically the entire like superstructure of the deal is built around that number. That's why that number is so important. Like we've had sellers who are like, who cares what the, like, we're talking about, $100,000, who cares? The reason is because the lenders, equity sources everything is done off of that. So everything is done as a multiple of that typically. And so in order to get that number right, typically a buyer will spend $50,000 just to make sure that number's right, or really like fine tune that number.
Here was an example that occurred recently. We were on the buy side on this one. There was a seller that had about 30 or 40% of their revenue coming from a contract that was going to end. Well, in that case, part of the quality of earnings was determining what was the amount of profit or the amount of revenue coming from that contract, and what would the value of the company be if that weren't there. We were then able to negotiate a deal based upon that. So that quality of earnings is incredibly important. Less critical if the company has audited financials, but even with audited financials, I'm seeing buyers do quality of earnings. The last one, and it's kind of an odd thing to put up there, is tail D&O insurance. It's kind of a minor thing in the scheme of things, but it comes up towards the very end of the process. And one of the real things about deals is that people get tired. It's a stressful process. Hours go long. You're making decisions about something you don't know a lot about. So as the process gets closer to closing, both the seller and the buyer's nerves get a little bit frayed. One of the things that will happen for the seller is that they're going to cancel their insurance. They don't own the company anymore. They don't need any liability insurance. However, the buyer's picking it up from there. Anything that happens prior to the closing is going to be the responsibility of the seller. If it happens after the closing, it's the responsibility of the buyer. It might be that something happened prior to the closing that isn't found out about until after the closing. Well, that's a liability of the seller. Tail insurance basically is a way of paying the insurance company to say, I'm terminating my insurance, but you're going to continue to cover me for things that happened prior to the closing for some period of time. Most buyers want it. Sellers will say, well, I don't want to pay that $20,000. If something comes up, I'll simply, make good, or we've got an escrow, or whatever it might be. And buyers pretty logically say, we want you to have insurance. We don't want to have to be trying to get money out of your pocket. As a buyer, how do you think about tail insurance?
I was laughing because 100% of the deals, I spend 45 minutes explaining to a seller that their insurance actually doesn't cover them for basically as soon as you close. If something comes out that happened on the seller's watch, like a lawsuit that they didn't know about, a cyber attack or something they didn't learn about until afterwards, there's no insurance for that, right? Because the buyer, like we put in place insurance post-close, but that doesn't cover pre-closing acts. So I laugh because inevitably it turns into a long explanation of why they actually don't have the insurance, and we insist in every single transaction they do. We're not going to buy a business that for the same reason that the way we described it is like for the same reason, seller, you didn't operate your business without insurance. We're not going to operate our business without insurance post-close. It just there's this weird gap that people don't realize in insurance, and it just needs to be addressed. So that's why I'm laughing, because literally, and it's always at 9 p.m.
It's always
a week before closing.
And the seller is exhausted and they're irritated and they're saying, you've already made me negotiate on this point, and why do I have to do this?
And my insurance broker's great. It's like, yes, your insurance broker's great. It has nothing to do with your insurance broker. It's just a feature of the insurance. So, yeah.
Okay. So valuation considerations, basically what makes a company more valuable or less valuable? One of the unfairnesses of the world, smaller companies get lower valuations than bigger companies. It's riskier to have a $7 million company than a $70 million company. So the multiples on bigger companies are larger. Flat or declining revenue, you might have the same $3 million of EBITDA, but if your revenue has been declining or your profitability has been declining, you're going to get a lesser multiple than if your profitability has been increasing and you got to that 3 million. So these are just some of the factors that go through. What are the profit margins? What is the backlog? What's the revenue customer concentration, contract concentration, the kind of things that you would think about. And this is important because, hey, listen, we all talk about the science and art of valuation. The science is getting to the EBITDA number and turning that into an adjusted EBITDA. Adjusted EBITDA is a conference in and of itself. But that's kind of the science part. The art is figuring out what's the right multiple. And these are the kinds of factors that go into determining the appropriate multiple when you're valuing a company.
Yeah. Just quickly on this, and this is one of the problems that we see oftentimes with like seller valuation expectations, is they'll hear, oh, like my buddy at the country club, she sold her business for 10 times EBITDA. It's like, well, yeah, every single one of those factors, the range in terms of what the multiple is probably 3 times EBITDA to like 20 times EBITDA is literally the range for each one of those. So you can imagine as a buyer, when we're doing due diligence and valuation work, we're looking at every single one of those and trying to factor those in. And so that's why valuation multiples can vary so widely for even businesses that may ostensibly have the same $1 million of adjusted EBITDA.
It's very funny. People will come up to me and say, on the sell side, and say, I need to sell my company for a minimum of 7 multiple. It's like, all right, that means that their golfing buddy just sold theirs for 6. My company is better than theirs. I know that. So, or they'll say, I must sell my company for $18 million. Okay. That means that their financial planner told them that they need $18 million to fund the various things they want to fund and to have the retirement that they want. All good numbers to know, just completely irrelevant to the value of your company. Yep. So when people come in with a multiple saying, or they come in with a number, I'm a little suspicious. I think, Zach, you're kind of indicating that. Yep. Let's open it up for any questions. We've been doing a lot of talking here. Any questions? Yes, sir.
Mike, please. So I guess this is directed at both of you, maybe Alex, for you in particular, with your kind of long, extensive background. And I'll qualify the question here in a moment, but what I'm interested in knowing is, what would you say the average rate of return on a M&A deal has been across your career? And as I said, let me qualify what I mean by rate of return.
We're getting into SEC questions, so I don't think I can answer that, but I can talk in generalities. No,
yeah. So I don't mean IRR, PE preferred, metric. I don't mean IRR. To simplify it, let's just say average 5-year net income after closing for the acquired assets divided by the purchase price. Or if, you want to use something more cash-based, free cash flow, assuming that, they're not having significant expenditures on capital that ultimately, are much above their depreciation and amortization.
Yeah, I mean,
I know that's a little complicated, but
yeah, and maybe one way to address it would be just to talk about like what is the cost of capital for small business acquisitions, right? I think so. If you think about debt to fund an acquisition, small acquisition, for example, if you're putting 2 or 3 times EBITDA leverage on a business, anywhere from 9 to 13 or 14% would be pretty typical. Required rate of, I mean, that's literally going to be the rate on the debt. For equity at that size, for big deals, think like levered equity is probably 20% rate of return. For smaller deals, it's probably 25 to 40% return, required rate of return that investors are looking to earn on that equity. So even as you think about like bringing on third-party equity, if you have a small deal, 2 million of EBITDA, generally the equity investors are going to be looking for probably 30% rate of return, as measured, a bunch of different ways you can measure that, but hopefully directionally, at least that helps.
I think the answer is also different if it is a person without a company acquiring a company. So you're really looking at what's happening to that entity versus a company acquiring another company. Because if it's a company acquiring another company, it's hard to figure out what is the synergy value versus the value just from the entity that was purchased. Very often there's shared services. They might have go into the same customer. There might be opportunities that they have that they didn't otherwise have. Hard to figure out exactly how to allocate that. And that's often been a problem in earnouts. But in a situation like Alex's firm, where they come in and they simply buy a company and they buy something that's got $25 million of revenue, and 3 years later, it now has $75 million of revenue. Well, that's a little bit of an easier analysis. Mm-hmm. Do you have a question?
You both talked about the tax advantages of equity deals. I was wondering, do you try to work with wealth management, collaborating with wealth management companies in that process?
Yeah, so it's tax advantage for the seller is an equity deal. As a buyer, we want asset deals. So like everything in tax, usually, unfortunately, it's one pocket or another. We have on occasion, I mean, sometimes, again, this is not tax advice. Please do not.
No tax advice
not
from us.
treat this as tax advice. Don't play one on TV. For example, earnouts, seller notes, other forms of deferred consideration. At times, it can be tax advantageous from the seller's perspective to get that income in basically another period. But generally, we're not going to, we wouldn't necessarily work closely with we'll work with their tax advisor, but less so on like the wealth side.
We'll work with wealth advisors because a number of wealth advisors will have people that still own their companies. So as I said, that we reach out to what we refer to as centers of influence, lawyers, accountants. We'll often send it to wealth advisors because they might have family offices that want to do acquisitions. So we don't definitely work with wealth advisors, but tend not to be too involved with them from the tax perspective. That's where the tax accountants come in. Yes.
Oh, you guys haven't talked about culture match, but we did a deal where private equity picked up a very healthy $90 million revenue company, and basically the M&A sort of lost value post, and of course lots of M&A does lose value. It's not helpful. So can you talk about the importance of that culture match when you're thinking about a bolt-on? Or
what do you think about that from a buyer side?
Yeah, as a buyer, and apologies, we should have said that. The number two issue after seller integrity is cultural fit. If you're talking about combining two businesses, again, I mean, businesses are collections of people working on a common mission, and you just see over and over again when cultures work well together, it's a wonderful, amazing thing to see. And it's not a knock on either culture. It's just there are cultural differences, right? Especially in small businesses, oftentimes the cultures generally reflect some of the personality characteristics of the seller. I'm sure you've seen that quite a bit. And so making sure that those cultures do fit, right? If one is a more like techie, growthy culture, and one is more of like a stodgy, compliance, nothing's wrong, like both are great. Probably a poor combination, right? Like you're going to have friction, you're going to lose employees, and you're going to have problems integrating. So that is absolutely something that we do kind of when we're looking to combine businesses, a very, very deep assessment on whether it's a good cultural fit.
Thank you very much for this presentation. Very informative. I'm Mike Curry, President and CEO of a company called Paratisec. My question has to do with valuation considerations. You mentioned a bunch of them, but I'm really curious about two, and one isn't on there, and it might not even be a valuation consideration, but you mentioned it earlier in the auditorium. That is client and contract concentration. What exactly do you mean by client and contract concentration?
In GovCon, there is client concentration. It's the federal government. There's one customer. So if you're looking at client concentration in GovCon, you got to be a little more sophisticated than that. So it may be that all of your work is coming out of VA. Well, that's some client concentration. On the other hand, is it coming from 6 different offices out of the VA, or is it coming from one contractor officer out of one division of the VA? That's a contract concentration that would be scary. Diversification out through lots of different decision makers, very significant. Contract concentration is one vehicle representing 80% of your revenue. Gosh, if you lose that contract, the company goes in the tank. So, is it a prime contract that you're unlikely to lose? It is a subcontract that's, God forbid, with Booz Allen, they might cut you. If it's with your friend from college, you're probably going to be pretty safe on that one. So the level of contract concentration is one analysis, and the customer concentration is a separate analysis, but buyers are very interested in both. Now, you're a buyer. What do you think?
Yeah, no, absolutely. And that's exactly what, I mean, we'll do a lot of deep work on understanding how much, if it is one customer, how many offices, how many different contracting officers, et cetera. And just always think, like, again, back to the point, the seller's always going to know more about their business than the buyer will. And so the buyer's antenna are always up. If there's a large contract that's a meaningful portion of the profitability of the business they're acquiring, as a buyer, you just need to get comfort that that's going to be there in the future and they're going to win that recompete.
No, that's great. And then you mentioned in the auditorium, backlog. I think I know what it means, but I'd like to hear it from you. How do you define and value backlog?
There's two terms that really are important. One is backlog, which are basically signed contracts. If you are a prime, it's the contract that you have with the government. If you're a sub, it's the contract that you have with the prime. And it is work that you can really count on. The government has issued out a task order. It's going to go for 5 more years. It's $10 million a year. That's backlog. Banks will lend on that backlog. They will take that, whether it's funded or not, they'll take that as real money. In contrast, there's pipeline. And pipeline are the things that you're working on that you don't yet have, but you think you might. So even a recompete, in my view, is pipeline. Certainly applying for an IDIQ, that's pipeline. Even if you've got an IDIQ and you've got a task order, you're applying for 3 other task orders, that's pipeline. Banks generally will not lend on pipeline. That's a little bit more iffy, depending upon what the history of it is. Backlog's pretty solid. It's contracted. Pipeline is what it is you're aiming for.
Yeah, that's it. Exactly. I mean, everyone I have seen 500, probably 1,000 GovCon businesses. I have literally never seen a business defined it the same way. I mean, there's like little nuances, right? But as a general rule, that's exactly how we think about it. Yeah.
I'm getting the sign from Zach that it's time for us to close this down. I want to thank everybody for their attention. And of course, thank my friend Alex Mears for participating in this. I hope that this has been useful for you, and I look forward to speaking with all of you.
Thank you.